To tonight's webinar. My name is Thomas Wood. I'm the Director of Trading Operations here at Microquant and also the host of the Futures Trading Room and the President of Superior Capital. Tonight we're going to be talking about short-term consolidation breakouts and how to trade them. A lot of really cool trading opportunities present themselves throughout the day in just about every market that you can trade, and you can trade them with minimal risk. And I'll show you how to maximize reward, how to identify profit targets, things like that off of these short term where the market takes a breather basically before continuing on or choosing a direction. Before we really get started, I want to go ahead and let you know if you ever have any questions throughout the webinar, feel free to submit them at any time via the GoToWebinar side menu located on the right side of your screen, and I'll try to do my best to answer them at the end of the webinar. If I haven't answered your question, feel free to send an email into support@valuecharts.com. We'll make sure that we get it answered for you. So before we really dive right in, I just want to go over a really quick risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Then any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you CFTC Rule 4.41. I'm not going to read through this one. Basically, it's just saying that it's hypothetical, meaning if we're showing you pictures of charts in the past, obviously hindsight's 20/20. Pretty easy to say, yeah, look, it worked great right there. Again, hypothetical results, they have limitations because it's not live. But that being said, we do trade these live. For example, I'll show you a couple examples that we actually pointed out today in the futures trading room. So what consolidation patterns do you want to watch for? There's a couple of them that are the most prominent ones that occur the most often. The first one is a pennant pattern. Okay, what you're looking for with a pennant pattern is a connection where the market is basically like a spring coiling up, going up and down, but getting a narrower and narrower range. And what you're looking for is that breakout where that market just takes off once it breaks out of the consolidation. So with a pennant pattern, you're looking for a big beginning range and then a narrowing and narrower and narrower and narrower range as time goes on. Now with these short-term breakouts, what we're going to be talking about today, they're basically for day trading, okay? So you're not necessarily looking to catch massive moves. This chart right here is a sugar chart on a 60-minute chart, and we actually had this trade in the trading room. Worked out very nicely, as you can see, because it trended straight up for the next several days in a row. But what we're going to be talking about today, and the examples I'm going to be showing a little bit later on, are all going to be off of 5-minute charts or tick charts. The reason being because we're doing short-term consolidation breakouts. Now the strategies are traded the exact same way. And what I mean by that, let me go ahead and erase all this ink. The way that you will trade this is you're going to put your long order right here on the outside of the pennant. You'll put your short order down here on the outside of the pennant. And then what I do with my orders, I have an OSO order. Say one starts other order. So as soon as this order is filled, your stop loss is going to be at about a 50% retracement inside this pennant. Now, if you're trading intraday consolidation patterns, a lot of times what you're able to do is put your stop loss, instead of putting your stop here, you're able to put your stop all the way up here. So if you're getting short, so let's say you were selling here, whoops, LL. If you're selling there, your stop is going to be able to go above the other trend line. Now, with longer term patterns, like a daily or a 60 or a 240-minute pattern, you may not be able to do that because that could be quite a bit of risk, that distance. But with an intraday consolidation pattern off of a 5-minute chart or off of one of the tick charts, you're able to do that because your risk is only going to be about $100 a contract, usually. And I'll show you some examples of that here in just a moment. The other patterns that you're going to be trading, you're going to want to look for ascending and descending wedges. Okay, with an ascending wedge, its pattern, the price has found resistance at a certain point, which means it's tested it several times and bounced off of it each time. And what you're looking to do is you're going to have a long order right there above that resistance. You're going to have a sell order below the support. The support's going to be off of a trend line that's connected to at least 2 well-defined lows, all right, or well-defined highs if it's a descending wedge. And what you're going to have is an OSO order. Again, stop loss can be placed above or below the previous support. One of the best ways I have heard stop losses or stop placement described is you want to have your stop far enough away that if it's hit, you know your trade idea was wrong, but close enough that if it's hit, you're not going to break the bank. So you want it far enough away that if you're right on the direction that market's going to be moving, your stop should not be hit. But if you're wrong, it's okay. You're not going to blow up your account. So again, you have ascending wedges, you have descending wedges, which is the exact opposite. Instead of having resistance from previous highs, you're going to have support from previous lows. So you're going to have your sell order down here. You're going to have your buy order just outside the upper end of that down trend line, going across the highs for resistance. What you're looking for it to do is as soon as it fills your long, your stop is generated down here. You're going to go back and erase your sell order. So you're going to have your stop loss right there. And then you're looking for that market to continue higher. Now, when you have your breakout, all right, the market technically should not come back inside your breakout pattern. So you see here where we broke out, we never came back inside the pattern. Now, granted, this one kind of an exception because it was right at the very tip. Over here, you see you did actually come back in. The reason this is okay is because this up trend line that was providing support initially for that ascending wedge, that's still providing support. And you can see this came right down to it a couple times and bounced right up off of it. That's why I say when you're trading intraday consolidations, you can have your stop on the other side of the support. So let's continue on. The last pattern that you're going to want to look for that occurs pretty often on an intraday basis is a channel. The way the channel works, if I can get this to work, there we go. You can see here, this is a tick chart. Now, channels happen on tick charts a lot more often than they do on time-based charts. So you can see this is soybeans on a 250 tick chart. And for those of you that trade equities or options, yes, I will show some equity examples as well here in just a little bit. But you can see with this, you had 1, 2, 3, 4, 5, 6, 7 price bars in a row trading inside the same range between 12.80 and 3/4 and 12.79 and 3/4. So you had a nice 1 cent range. What you're looking to do is as soon as this breaks out, so you're going to have your sell order 1 tick below the support, and you're going to have your buy order 1 tick above the resistance. As soon as it hits your sell order, your stop loss gets placed above the high. So with this example for soybeans, your stop's above the resistance that was those highs. You're only risking a penny and a quarter. Okay, so you're risking $62.50 per contract with soybeans. You're looking for this market to move down. Now you can see here it actually came all the way back up and retested that resistance. That's why your stop stays above the higher resistance level. Not the support level, it stays above the higher resistance level. Sometimes you'll see a market break lower, come up and hit what was support, and the support will cause it to go back down. Not always. You're going to be even more safe if your stop is up there. And again, the goal with your stop placement is far enough away that if it's hit, you were wrong on the idea. So that gives you 2 different levels of resistance to stop the market. It ends up selling off. So you risked a penny and a quarter. It ends up selling off all the way down. This is about 75. So you risked a penny and a quarter and you made 4. Okay, if you got out at the bottom. Now, the way you can time your exits, you have a couple different things you can look for. For a long, you're looking for it to go significantly overvalued, which is the upper red bar segment on value bars. If you're going short, you're looking for it to go significantly undervalued. So that would have been your profit target right there. So you would have risked a penny and a half or a penny and a quarter. You would have made about 2.5. Now again, this is just a short-term consolidation breakout. You can trade these exact same strategies the same way on longer time frames and catch much larger moves. So we're just talking about day trading here, which is basically some scalps. So does everybody understand that? Your profit target is going to be significantly over or undervalued, or it can be a divergence, or if you're looking for, let's say we were looking at this on a longer time frame, on a 30-minute or a 60-minute chart, and we said, okay, it looks like it should go down longer term, so what you do is instead of getting out when it hits significantly undervalued, you just go ahead and put a break-even stop in place and try to catch that market moving lower for a longer time. A penny, a 1-point move or 4 ticks in soybeans, which is 1 cent, is $50 per contract. Each tick is $12.50 per contract. So each quarter is $12.50. That's just for soybeans. Each futures market has their own thing. Now granted, wheat, corn, soy are all the same. So does everybody understand those 3 breakout patterns? We have the pennant, or the 4 breakout patterns. We have the pennant, we have the ascending and descending wedge, and we have our channel. Now you can have channels. A channel does not have to just go sideways like this. You can have a channel where it's set up and the market's going down, so you have a descending channel, or you can have an ascending channel where the market's in a channel but going up, and you can trade the breakout the same way. Okay, stop with an OSO order gets placed at the low, so your stop entry, your exit, or your stop loss order is going to be above the previous support or resistance. Profit target is going to be significantly over or undervalued depending on the direction that you're trading, unless you have a valid reason to expect that market to move further, and then you can use a longer term profit target and just use this as an entry timing tool, so a tool to time your entry. So if there's no questions about those 4 patterns that we just talked about, wedges, the pennant, and the channel, then we'll go ahead and pull up some real-time charts. Can I please go over the patterns one more time? Sure. Your pennant pattern is kind of like a spring. You want to have a big initial move, and then you want to see that market slowly consolidate and kind of coil up. So it's getting ready to make a much bigger move. And what you're looking for it to do is break out. Normally, you'll see what you want to do when you're drawing your trend lines for these pennant patterns, and for any trend line you're drawing really, is you want to make sure you're taking the very obvious turning points in the market, so the very obvious highs and lows. You don't want to draw a trend line on an obscure point, so you wouldn't want to go from this high to that high and across, because this high does not really count as a very good point to catch or to attach a trend line to. So you want to make sure you're taking the very obvious ones. Again, with a pennant pattern, you're just looking for the market to have had a large initial move, and then consolidation gets tighter and tighter and tighter, getting ready to break out. A lot of times you'll get these kind of patterns before announcements. If a market's kind of holding its breath, waiting for an announcement to come out, so it can have the fundamentals to drive it one direction or the other, you'll have these type of patterns a lot of times because the market's just consolidating, waiting to move. Is there a certain number of consolidation waves? You want to see, for a pennant anyway, you want to have at least 2 points at the upper end and 2 points on the lower end. You can have more. I mean, you can see here this had, let me erase some of these drawings, but you had a couple times that you actually tested it. So you tested it there, basically hit it here as well, just about hit it there, finally broke out, and then retested and took off. Here you hit it there, you hit it here, you hit it here, just about hit it down there. So it really, it depends, because you can have pennants, you're going to have at least 2 points. So 1, 2, 3, 4, 5. All right, moving on. Looking at your ascending wedge. Again, you're going to have a trend line which is drawn off of significant turning points. You're going to have resistance where the market's bumped it and fell off the exact same price a couple times. You're looking for the breakout above or below either direction. You recently bought Noah, which was in a pennant pattern, was predicted to break out, but it has abruptly dropped 20%. Comments. Did you buy it before it broke out? So you bought it before it got out of the pennant pattern. That's why your orders to get long and to get short, we traded. This is an actual trade we took in the trading room, this one right here. Now again, this is on a 60-minute chart, so it's a little bit different, but it's in sugar. We had orders to be long right there. So you waited until it actually broke out of the pennant to get long, and then your stop loss was down here for this example when we traded this in the trading room. Is there a higher probability of breaking up or down? Honestly, there's some people that will tell you there's a higher probability of breaking one direction or the other with ascending and descending wedges. I honestly don't care what the probabilities are. I do not get in until it's broken out. So I wait for it to get out. You do not have to wait. You don't have to wait for it to close outside of the trend line, above or below the trend line, because you'll get something like this where it breaks out and then rallies quite a bit right away. You get in it as soon as it breaks out. You don't wait for it to close. And then you have a channel, which is essentially two resistance and support levels that a market is stuck inside of, and then you're looking for it to break out above or break out below. Don't try to guess which way it's going to break. That's a risky thing to do. It can be painful too. How far will it move after the breakout? Well, you're going to look at your longer time frame charts, but if you're just trying to day trade it, your profit target is going to be significantly over or significantly undervalued according to value charts and value bars. All right. So pretty simple concept. Do I have a favorite of the four? Pennants are my favorite. Is there a scan that can find them for you? Not that I know of. No, you don't wait for it to close above. You get in as soon as it breaks above, as soon as price action hits above the certain point. How long does a new room normally hold these trades for? It depends. For example, this sugar trade that we took, we were in this for several days because it was intended to be a swing trade because we had been consolidating for a week and a half. And you can see it rallied. Each one of these vertical bars are 1 day. So that rallied a pretty decent amount. Gold broke the trend line but did not follow through. We'll see. Still watching gold. Just giving it a little bit of time. I'm actually in gold short right now off the trend line breaks. We'll see what happens to it. All right, any time frame that works better. 5-minute charts work really well, but you can use it on any time frame you want. Tick charts, you can. I don't like tick charts as much except for channels. Okay, so channels, I like tick charts a lot. I don't like tick charts as much for pennants, wedges, but 2-minute charts, 5-minute charts, etc. So let's go ahead. What we'll do is we'll pull up TradeStation. We'll start looking at some examples from price action of today and yesterday so you can see them, not just going back and cherry picking these. And then I'll ask you can give me a couple markets that you want to look up. We'll pull them up and see what kind of consolidation patterns, if we had any today or yesterday. So 1 second, pull up TradeStation really quick. First one we have up here is gold. Gold had a pretty decent consolidation. We talked about it today in the trading room right as we were getting ready to close, because you can see the trading room closes at 12 o'clock. Futures trading room anyway, closes at 12 o'clock. We were talking about this right here. You had a pennant pattern in gold on a 5-minute chart. You can see right where it broke out. So you broke out right there, and it rallied from, let's see, it jumped up from 26.30, ended up topping out at 12.32. So about a $6 move or $600 per contract. No, there's not a scan for these. Not a scan that I know of anyway. So it had a pretty decent sized move off of this pennant breakout. The other thing that you could have been watching is you ended up having a really nice, well-defined trend line that ended up developing on this 5-minute chart later throughout the day. Right at the end of the trading day, we broke that trend line, and we've since then been heading lower. We broke through a 120-minute trend line here recently as well, so I'd like to see gold really move lower throughout the night session or the Asia session. We'll see. So with this example, you would have been long from 1226.40. Your stop loss would have been either about a 50% retracement inside of this, or it would have been below the lower end of the pennant, which would have been at 25. So you've been risking $140 a contract, and you would have made 600 if you got out at the high. If you got out on the trend line break, you would have made 500. Make sense? All right, let's go ahead. Let's take a look at some more markets. Is there a pennant in gold right now? No. Let's take a look at RBOB. This is another one we talked about in today's trading room, in the futures trading room right here. You had a nice pennant pattern right there. You can see it broke out right at 267.25. So 6725, it went all the way up, ended up retesting the daily trend line like we said it would, and bouncing off of there. I sent that out on signal feed that afternoon saying watch for it to retest the daily and head lower, and it hit it to the tick and came back down. So if you took the long on the breakout at 67.25, got out at 68.95 on the retest, you ended up making about $800 or so a contract. A little bit less, about $650, $700 a contract to the upside. Your risk on this trade, I would not have put my stop all the way down at the bottom, because that would have been risking $400 a contract or so. Stop would have been halfway in the middle. One of the things that you want to see that adds credibility to your trade is the immediate reaction when it breaks. See how this immediately broke and climbed quite a bit? When it does that, normally you're in good shape to just go ahead and put a break-even stop in place and let it run. Okay? That is a very good sign. Ideally, you'd want to see that happen on everything. Sorry about that. Had to sneeze. So that's a really good thing when it happens. It adds credibility to your breakout. Again, this is another one of the ones we traded in today's, well, I didn't personally trade it, but a couple people in the trading room took it. We pointed it out saying watch for it to break out, and then it did end up breaking out and following through. Let's take another look. Let's take a look at the Russell. This is another one we pointed out today. You had a descending wedge right here, and we had seen one. You had 3 different points that you tested the support level. 1, 2, 3, basically 4, I guess you could say, that it hadn't broken, and then you had a nice descending trend line. So you had a descending wedge up here in the Russell. We said watch for it to break out. It broke out to the downside. That was right there at 56.20 basically. If you held on to that, you should not have been stopped out here, because your stop could have been above the high of the descending trend line. It ended up dropping from 56.30 all the way down to a low of about 11.50, so about 6.5 points, a little bit less, 6.25. So worked out extremely well. Again, that's another one we pointed out in the trading room today, right before the trading room closed, because you can see right here, 12 o'clock. That's when the trading room closed at. So had another great opportunity there. Again, these patterns, these consolidation patterns, happen all the time. When you find them, a lot of times you can really take advantage of them. Let's see. what else we have. Sorry, I'll answer. There's a whole lot of questions coming in, so I will answer a few here in just a moment. When we get through the rest of the futures, then I'll answer some questions and we can take a look at some equities. Just have a couple more examples I want to point out. Another one was crude oil. Now, this is not one I pointed out in the trading room because this was after the trading room. But you can see, remember I said a channel can occur on a descending or ascending channel. It doesn't necessarily have to be sideways. You had a nice channel develop here in crude oil, and you can see what happened when crude oil broke this. It actually came back and retested it right here. When a trend line is broken, it then becomes support. So it was once resistance, it became support. So if you didn't buy on the breakout right here, you still shouldn't have been stopped out even with this retest. This would have been your second buying opportunity. The retests are oftentimes an even better opportunity because they do just this. They test it almost to the tick and then take off. This crude oil, it ended up jumping out of this channel from, let's call it 93.80. It just had a high tonight of 94.07. So not bad, talking about $270 a contract. Pretty decent size move. What are the trading room hours? The futures trading room is from 8 a.m. until noon Eastern time or New York time, and the options trading room and equities trading room is from 9 a.m. until 1 p.m. Eastern time or New York time. Let's go ahead and take another look. Actually, that's going to be it for the futures that I had pulled up. So what we'll do, I'll answer some questions, then we can go take a look at some equities, what they've done the past couple of days. Make sure you're trading a market. You want to have a market that has volume in it. You want to have a market that is actually moving. So, for example, right now, if you look at RBOB, right now, you don't want to be trading RBOB a breakout right now because there's no volume. Look at how choppy this is. I mean, you're talking 2 or 3 contracts traded. You want to do it when there's going to be volume so that the market has follow through. All right. If it looks like this, I never trade a market that looks like this. That's impossible to trade. That right there, it's impossible to trade. Nearly impossible to trade, I should say. So you don't really want to be trading those. Let me go back. Hold on. Try to answer some questions. You're not sure you understand ticks versus time and when to use. You can use either one at any time. What happens is tick charts will not have this. Okay, you see how this is all gappy in RBOB, for example? Tick charts won't have that because it only makes a bar after a certain number of trades. Time-based charts, if there's no trades for 2 hours, looking at a 5-minute chart, then the chart's just going to go sideways with a lot of bars. It's one of the reasons I like tick charts. Tick charts also show you what could have happened. For example, in RBOB, you could have been looking at a tick chart and seeing it maybe sit here bounce for 2 or 3 minutes inside this 5-minute bar that you can't see on a 5-minute bar, but you would have been able to see on a tick bar. Is your stop on the current bar that breaks the pennant or the previous candle? For example, with your stop for this, it would be about a 50% retracement into this pattern because you don't want to see it. Technically speaking, it should never come back inside of the pennant. Sometimes it does, but technically speaking, it shouldn't. So your stop is going to be just inside of the pennant because this is kind of a barrier. Because remember, once the resistance is broken, it then becomes support. What is the stop for the short on the 120-minute chart? We're not talking about that right now. Can you show me some of the Dow or the S&P charts? Sure, we can take a look. Here's the S&P. You can see here you had a nice sideways moving support level that was developed. When broken, you can see you hit it 1, 2, 3, 4, 5, 6, 7, 8 bars in a row right at 1832. When it broke that, it really dropped. So you could have been trading the break of that support level. You could have been trading a consolidation period right here. You had a sideways channel basically in the S&P. You're bouncing up off the highs and lows a few times, finally broke out and climbed pretty decent amount. Again, they'll happen on just about every market out there throughout the day. So I ignore the red tops on those. Are you talking about when I was looking at RBOB? Well, the reason, remember, if you don't have a longer term profit target, you get out at significantly overvalued. So for example, if you were trading this RBOB breakout and you didn't have a longer profit target, which we had a profit target of RBOB retesting the daily trend line, which I can show you here in just a second what I mean by that. If you don't have a profit target, then you're out right here. Yeah, you miss out on the rest of that move. That's okay. You're just trying to day trade it to get a quick scalp out of it, basically. We had a longer-term profit target of a retest of this daily trend line. So we broke the trend line the other day. We said, okay, if it goes up, it should test the trend line. And you see right there, it went to the tick and hit that trend line and has pulled back from there since then. So that's why we said it should continue higher past the significantly overvalued. Keep in mind, value charts aren't designed to just sell if it's red or buy if it's red. That's not how they're designed to be used. They're designed to work alongside your analysis to help you identify significantly or low probability market prices where market rarely trades, moves that a market normally does not make. Okay. That'll be the pinnacle of trading, entries with zero stop loss. Yeah, you can have false breakouts. You have to be aware of that. You can have false breakouts. By the way, let me see what just happened. I think I just got stopped out of gold. Yeah, I just got stopped out of gold. Oh, well, we'll see what happens to it. Normally I don't trade breakouts at night, but figured I'd give it a try. Let's see. You can have false breakouts. Perfect example, gold just had a false breakout. Granted, it wasn't on an intraday trade. It was on a longer time frame, but you can see I was short off of this break of the trend line right there. My stop was just above the trend line right here. It has since bounced back up above the trend line, did not follow through. So you had a false breakout there. That can happen intraday trading as well. So just got to be careful about that. Let's see. Now, stop crude channel trade. What was a stop on the crude channel trade? I didn't trade the crude oil, but if I had been trading crude oil on that channel, your stop would be about a 50% retracement inside here. So it would have been right here below this. You have a couple bars that form a little bit of support right there. So it would have been just right down here. Let's see. Why don't you use candlesticks to analyze breakouts? You can, just not the way I trade it. How does natural gas look? We're not looking at natural gas right now. Is there any one future that you seem to be trading more than others? No, we trade the setups as they appear. So we might be trading crude oil. We might be trading, for example, we were short crude oil. I mean, we had two really good entry opportunities that we pointed out and traded. I traded this one, did not trade this one here in crude oil this morning, right at the open of the trading room. Worked out really well. We had longs in nat gas earlier today that worked out really well also. Now natural gas ended up reversing, heading all the way back down, but that's a story for a different time. What do the red and yellow parts mean? What those are, that's value bars, is showing you moderately overvalued and undervalued and significantly overvalued and undervalued, and then fair value. So green is where a market should trade. Upper yellow means it's up a little bit too high. Lower yellow means it's down a little bit too low. Upper red means it's rarely trades up that high. Lower red means rarely trades that low, basically. What if it breaks pennant? Do you enter a stop order for entry since the slippage will be high? Your slippage is not always really high. I mean, it can be, but not always. So it just depends how you want to manage that. Let's see. Some markets you will have a lot of slippage. For example, if you were trading gold the other day, you probably, if you were long and you had a stop, a sell stop, you probably got hammered a couple days ago because it dropped $35 an ounce in a second. That's the risk you run. I always use stop markets, so I don't ever use limit orders. It's all about the probabilities. That's correct. Do I give importance to fundamental announcements, or do I just trade the technicals? I trade purely off of technicals. Now, that being said, I'm not going to ignore fundamentals. So if a market, if, for example, we go to war or something, I'm not going to say, well, I'm still going long the indices or the stock market because I think it's going up. No. You got to pay attention to fundamentals. Doesn't mean I trade off of them, though. Why would I trade a bottom trend line from that skewed action in gold? It seems to be such a rare occurrence. Reason being, it's a significant turning point. It doesn't matter that it happens rarely. It's a significant turning point. Looking at natural gas, broke above the previous day's high and then pulled lower than the previous day. Would I still be bullish? The weeklies still look bullish in natural gas. The dailies, like I said in the trading room, it needed to break through the weekly high, the previous week's high. Didn't do that. Broke through the previous day's high, which was good as well, but we needed to break through the previous week's high. By the way, taking a look at gold really quick. You have a trend line going across that high, put a parallel on there, it does not quite line up, so never mind. But you do have a little bit of resistance right here in gold at 29.30 for those of you that are watching gold. Let's go ahead and take a look at some indices, some of the equities. You want to trade, I'm on a different account, so I don't have live equities data. I forgot about that. I was on a different account earlier. Here is an example of a nice pennant pattern that you had in Apple right here. You can see you had the wide range, the narrower range, the narrower range again, and then finally the breakout ends up climbing up very nicely. You had another one right here, another pennant pattern right there on the 5-minute chart, bouncing off the highs and lows, finally breaks out, climbed up again. So this is just on a 5-minute basis. You can see over here the other day you had a nice 5-minute trend line coming up across all these lows that it broke through right at the end of the day, sold off quite a bit, and then gapped down the following day. Now granted, you filled that gap the next day, but you're just day trading, so you would have been out by the end of the day anyway. Today you had a nice channel that gold was trading, or that Apple was trading in for a little while there.
Order filled.
Sorry about that. Turn off my volume. You had a nice channel that Apple was consolidating in for a little while here. It finally broke out right there, retested the resistance that was previous support. Like I said, sometimes you'll end up seeing it retest the support instead of the resistance at the high. So it retested the support and then continued down. Either way, your first profit target was already hit because it was significantly undervalued. That's still a nice move in about 5 minutes from 40.25 down to 39.12 or so. So not a bad move. And if you held it the entire time, it dropped $2, a little over $2. So not a bad move there either. Well, let's go ahead and take a look at Google. Again, you want to trade markets that are volatile so they move, and you don't want to be trading markets that aren't going anywhere, that have no volume or anything. Let's look at Google. Goog. You had a nice ascending wedge pattern here yesterday. A very nice trend line coming across the lows. Oops. If I can connect it to the correct low. There we go. So very nice, well-defined trend line, been hit 4 times across the lows. You had resistance that had been hit 1, 2, 3, 4 times as well. Finally broke the high and just took off and never looked back. Again, today you had a nice channel. You had 1, 2, 3, 4, 5, 6, 7 price bars that bounced off the highs and the lows of this channel before breaking out to the upside and then continuing higher. You see it actually ended up coming all the way back down, retesting that support once more before heading up the rest of the day. So that ended up working out pretty well there. Also, again, that trend line on the 5-minute chart in gold is at 1229.20. For those of you that were watching that. Let's see. More questions. Is the red sort of like a Bollinger Band? Similar to a Bollinger Band, but the algorithm is completely different, so it shows a completely different price level, basically. It goes into a lot more detail on how far over and undervalued it is, and you can actually look up, you pull up your price action profile, you can actually look at exactly how often a market trades above or below a certain point, the exact percentage. How often do you get stopped out on a day trade? How often does it go against you? The probabilities, if you actually have a correct breakout pattern, the probabilities are in your favor. You're probably looking, now this is just a guesstimate, but it's probably 70 to 80% that it's going to work out if you have an actual consolidation pattern. If you're just drawing an obscure trend line that nobody else is paying attention to, probabilities go down. Give me 1 second. Let me actually log into a different account so I have live equities data, and then I'll pull up BMW and Twitter. Alrighty, sorry about that. Let me pull up Twitter. What's my opinion on Twitter? Your dailies actually look pretty bearish. You had a nice bearish divergence. Looks like it should head lower. You had a really nice yellow hat doji right there. Had a really nice red jacket doji right there at the highs. Momentum looks weak on your daily, so it looks like it should continue to go down as long as you can break through the support. What about BMW? VMware. Wow, it had a big up move today. It broke out of a channel. There was your resistance. Here is your support. Broke the channel earlier today, took off. That's exactly what we're discussing. Like I said, you can trade it on longer time frames as well. You don't have to just trade it on a intraday chart. Now, that being said, you can trade intraday. Same thing. Let's see. KKD. Can look at that. Sure. Krispy Kreme. I was taking a look at your dailies in Krispy Kreme. You're actually in a bit of a channel here too. There's your support. You've hit it 4 times now on your dailies. You're going to have resistance at this previous daily high, so you're watching for the breakout. Upper end's at 2005, lower end's at 1904. Are these indicators available on all TradeStation accounts? Yes, but you have to purchase them. If you go to valuecharts.com, you can purchase the indicators. Do I trade Forex? Yes. I trade a lot of the futures, currency futures. I don't trade the currency pairs as much. I used to trade them a lot. Now I switched over and started trading futures more. All right, so what we're going to do, we'll go ahead. That's going to be about it for today. Normally we try to keep these about 45 minutes long. So I want to thank everybody for coming. If you have any questions that weren't answered, feel free to visit or send an email to support@microquant.com or support@valuecharts.com. If you want to join one of the trading rooms, you can get access to Signal Feed, which is a service that's on your computer. We send out signals straight to your computer or your cell phone or your email, whichever way you want it, throughout the day. We also have trading rooms, so you have access to both the futures and the options equities trading room, and you get a daily premium video that talks about a trade setup, and you'll get a monthly newsletter that talks about some monthly and longer term setups that we see developing. That's only $97 a month at the moment. That's the Platinum membership. If you're interested in that, go to valuecharts.com and check it out. But again, that's going to be all for today, so hope everybody enjoyed it. Look forward to seeing many of you bright and early in the trading room tomorrow, and I know Dave is looking forward to seeing a lot of you in the options and equities trading room tomorrow as well. Does Signal Feed alert you, or do you have to sign in and alert? Look, it runs in the background on your computer and pops up an alert as soon as it happens, as soon as we send it out. For example, I sent out a short signal in gold last night. I told everybody expect gold to head lower today because of a candlestick reversal on the daily. Yeah, we had a problem. For some reason, my video, the premium video I made today and yesterday, weren't showing up correctly, so that should be fixed by tomorrow. How do you sign up for the alerts and signals? As a Platinum membership, if you sign up for a Platinum membership, which, like I said, right now it's half price. It's only $97, but that we have that limited to 250 people, and it's almost full at the moment. But if you get a Platinum membership, you have access to Signal Feed as well as the trading rooms. Great perspective on trend lines. Thanks. You're welcome. Again, look forward to seeing everybody bright and early tomorrow. That's all we have for today, so hope you enjoyed it. And until next time, can you be in both trading rooms? Yes, you can. So when you send out Signal Feed, like last night, if you're looking for a short on the 5-minute, would we be? You could be. There's a couple different ways you could time it. You could either just take it short straight off the dailies with your stop above the daily high, or you could look for an intraday entry, which is what I would do. So again, that's it. I hope everyone enjoyed it. And until next time, happy trading.